So I realized that I need to invest in order to build my financial security. And this is the key lesson. You need to start as a business owner. You need to diversify into real estate. You need to diversify into the stock market because this will give you more security.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Hey, if you're a high-income professional building wealth through real estate, but you've also got money sitting in the stock market, this episode is a necessary reset. Because one of the biggest threats to your long-term returns isn't just the market, it's what gets quietly siphoned off in fees, bad incentives, and the get-rich-quick advice. Today, I'm joined by Robert Rolih, the international best-selling author of The $1 Million Decision and a long-term investing expert who's helped over 7,000 investors across 70-plus countries simplify their approach to build wealth with more confidence. He shared the stage with those like Robert Kiyosaki, Gary Vaynerchuk, Brian Tracy, and even Jack Canfield, and has been featured on news sources such as CNBC, Yahoo Finance, and Bloomberg, of course, among others as well. In this episode and conversation, we're going to break down why small fees can become massive over decades and what fee levels you should actually be targeting, including his ETF index fund rule of thumb, and why short-term trading is a trap and how it's often engineered to benefit the industry, not the investor. And lastly, how to avoid overcomplicating your portfolio and what simple, repeatable, and automated investing can look like so your strategy doesn't require constant attention. So this one is for you if you're building a real estate-driven wealth plan, but want to round out your allocation, clean up your fundamentals, and make sure your stock market exposure isn't quietly leaking returns. And just to be clear, this show is still real estate first. I'm not trying to cover every single investing need, but I'm committed to serving you, the listener, the tech professional here, with the fundamentals across the bigger wealth toolkit so that you can make smart decisions everywhere you deploy your capital. So before we get into the show, please, if you get value from episodes like this, subscribe to the show, leave a review. It's the simplest way for more investors to find the podcast. If you want to go deep with Robert, check out the show notes for his book where else you can connect with him. Thanks so much and enjoy. Hey, welcome to another episode of Path to Passive. I'm your host, Stephen Arita, and today we're joined by Robert Rolih, an international best-selling author of The $1 Million Decision, a long-term investing expert whose work has helped more than 7,000 investors in over 70 countries simplify their financial lives. Robert, thanks so much for being here. Tell the listeners a little bit about your background, and then we'll dive into some specifics.
Yeah, great to be here. Thank you for inviting me. Yeah, my story is a very interesting one. I was born in a small country, Slovenia, that is 2 million population near Italy and Austria. And my parents were working class workers, and we never had money at home. And that is why I always wanted to become someone, to become wealthy. And when I did that in my student years, I started my own company. And after 5 years of hard work, this company started to produce a lot of profits. And at that time, I knew that I should invest part of the money that I'm making, but I didn't know how. So I trusted financial advisors and bankers. But unfortunately, after years of investing with them, I realized that most of that money is gone. And that was one of the darkest period of my life. I lost most of my money. I became depressed. I lost my motivation to work. And at that time, I made a promise to myself. I will become one of the most financially literate people in the world, no matter what. So in the next years, I learned all there is to know about investing, about personal finance. And I talked with a lot of financial industry insiders, and I realized that the financial industry is not on our side when it comes to investing, that their interests are not aligned with our interests. And when I started to to use all the knowledge that I gained during these years. I got my investments back on track. I started to profit from my investments. The rest is history. Then I wrote my book. I started to do a lot of seminars, webinars, I'm trying to help people avoid making the same mistakes that I did. It's a good stuff.
Yeah, there's no journey, no successful journey without some challenges and things along the way. And it's super cool how far that you've come. And, I think the listener is, we always have to address and dive deeper into what your, some of those challenges are. And one of the things that you mentioned, which I think is important to educate on, I'm sure is part of your story too, is what do you mean that, the financial advice, most financial advice out there isn't aligned to the investor interest? Can you expand on that?
Yeah, sure. So let me give you a very simple example. Now, for example, if whenever you are investing your money, you are paying fees. Usually, these fees are small. For example, you pay 1% management fee to your financial advisor or to your fund, and this may sound small. But you need to realize that it's not just the fee that you lose. You also lose all the growth that money could have made for you over time. So let's take a look at an example. If your portfolio is worth $100,000, for example, a 1% fee means that you pay $1,000 in the first year. And that 1,000 is not only gone, but it's not longer growing for you. So if the market, for example, grows about 8% per year, that 1,000 could have turned into more than 10,000 over 30 years. And that's just from 1 year of fees. And if you account for all these fees over 30-year span, the total cost is over 120,000 in lost growth, and that's more than your current portfolio value, for example. So one of the biggest dangers when it comes to investing are fees. These fees may seem small, but in reality, over the long run, they can rob you of your financial freedom or future. And that's the core message that I'm trying to get across. So even if you are a regular investor, maybe someone investing just 5,000 or 10,000 per year, you can easily lose over $1 million by the time you retire. Okay, so this is huge. This is a lot of money.
And so it's you're talking about a 1% fee. I would think that sounds pretty low, right? Are there other things, what is less than a 1% fee that someone should be looking for? Because I've certainly seen things where there's 2% or 3%, which obviously would be high. So, what should people be looking for if it's not 1%?
Yeah, good question. So my guideline is that the management fees that you are paying for your long-term investments, for example, in the stock market, they should be less than 0.2%. So less than 0.2% per year or annually. This means that the only viable solution are ETFs or index funds. These are basically, you are investing in a basket of stocks. For example, S&P 500 basket of stocks. These are 500 biggest US companies. And you are paying only 0.2% or 0.1% or even less, 0.05% per year to the fund. And this is really, really this almost doesn't affect your long-term returns. You still keep almost all of the profits that the market will bring you over a long period of time. But if you are paying 1% management fee, for example, if you are investing in a mutual fund, or if you are using whole life insurance, or if you are paying this much to your financial advisor, this can really hurt you a lot, like I said in previous examples.
Okay, got it. So obviously, if it's not 1% and higher, that's what we don't want. You're talking about things that could be, I would say 20% of 1%, or that 0.2, or even, a tenth of 1%. So significantly less. And, you just gave examples of what some of those things could be as well. ETFs, index funds. So, all right. So fees is one of them where, it's not aligned to our interest. A fee is going to be there because we're investing into a product, and, it's someone is doing, I always say, if it's really passive for one side, or the person investing is kind of going to be active, or some work is going to be done for the other side, right? So what's another thing that maybe even really, smart people, quote unquote, analytical people, would fall into the trap of that isn't aligned to their investor interest?
One thing that the financial industry is pushing hard and advocating is short-term trading. Now, why? Because they are, of course, making a lot of money when people trade all the time. For example, day trading or swing trading, you are making trades all the time. But this just means that you are constantly paying a lot of fees and commissions. And this is good for the financial industry, but of course not good for you. And when it comes to short-term trading, I soon realized, of course, in the beginning of my investing career, I also tried to get rich quick, speculating by day trading and stuff like this. It never works. I have thousands and thousands of members from all around the world, and the most common story that I hear is that they tried some kind of short-term trading, trading forex, trading stocks, crypto. It never works. I haven't heard one story of someone who would be successful in this endeavor. So this is only good for the financial industry and a few professionals. Maybe 1%. I recently saw a comparison when they compared success of going to casino and success when it comes to short-term trading, and they found out that it's much more profitable if you are going consistently to casino. But we all know that even when it comes to casino, the house always wins in the long run. The losing game, the losing game when you try to win the casino is much better than short-term trading. So now you probably know how dangerous short-term trading is, if it's worse than casino.
Yeah, and especially as we're talking about people that, many people who do want to invest and they want to see their capital working for them. If you're doing something that's short-term, that's pretty much got to be your full-time job, right? You got to be looking at things, tracking things, understand the market signals really well, and be extremely sophisticated to be doing that, but not something to have your capital working over time to grow more and more. All right. So
yeah, and one more thing here. When it comes to short-term trading, the ROI, when you calculate your ROI, return on investment, you need to also calculate the value of your time, because this is very time intensive. And if you spend, let's say, 5 hours per day trading, this is a lot of money. Your time translates into money. So if your hourly rate is, for example, $100, if this is the value of your working hour, you need to calculate this into the ROI calculation. And this is something that short-term traders never do. So in reality, most of them, they are not only losing money because, of course, the professionals are winning this game, but they also don't account for the value of their time. So if you draw the line, it would be much better if you get another job, maybe working for McDonald's, and it would be much more profitable.
Yeah, that's a really good point, because if you are doing that, I mean, even if you had started and you built this skill, exactly what it is, like you're talking about, we have higher income professionals listening to the show, and it's those who may not have a lot of time on their own right away. And if they are, it is to develop another skill like real estate investing, or it's like something else to develop what their primary skill is in tech, or something else that continues to earn income for them. And a short-term stock trading is another skill, just like you described. Okay, so we have the short-term investing is something that's like, okay, this is something that people can fall into a trap of. Another one is, definitely not paying attention to the fees properly. As good ones. Now, I'd love for you to give us a little more of your background. I'm curious, as you were talking about, the story, and not just story, but lived experience, right? Is what give us a little background, like what was that business in? And the reason why I ask is, well, to provide some texture about you, but also as you're thinking about being an entrepreneur or a great operator, right? You're thinking about, well, how can I make my money work for me as well? Is that about right?
Yeah. My first business that I started in a student dorm was web design business. That was before the year 2000, when internet was all the rage. And I learned how to code myself, how to create websites, and I started to offer this service to entrepreneurs. So I started to build websites. And this was my first business, but I didn't succeed right away. It took me like 5 years to really learn how to sell this service, how to market myself, how to create a team that was producing these websites. So it was a lot of learning in the start of my career. So I was not like some kind of overnight success. But this business enabled me to increase my income over time. And soon it became, after 5 years, it became very profitable. And then because we were very good at marketing and selling, we also created another company that offered business education. So we organized a lot of seminars, workshops, mostly about selling, leadership, marketing, so business skills. Mm-hmm. And this was another business that I ran at that time. But after the year 2012, I closed all the other businesses, and now I'm focusing only on the business that I'm currently in, and this is long-term investor education. So I'm running different programs about long-term investing, and I'm teaching people, about all the mistakes that they can make when it comes to managing their money and especially investing their money, because I went through all the pitfalls. I made all sorts of mistakes when it comes to investing, and now I can share this knowledge and help people avoid all these mistakes.
Yeah, absolutely. I mean, and you said, shutting those businesses down in 2012. So that was even, from 90, I think you said 99, to, all the way through 2012. So, good 13 years, not to mention investing and looking at markets, between 2006, 7, 8, 9, 10, right? So there's a lot of activity there going on with the markets, and great, global financial crisis and stuff like that too. And so you were running the businesses, we're talking about 5 years of really skill stacking, seeing what things worked. And well, we have a fellow techie in the house as well. So pleased to have you here, Robert. But, you're probably thinking, you're probably looking at, like you were saying, investing your business profits into the stock market and in investing in general along the way. And so, there's having your money work for you. That's investing, hoping for a greater profit with your capital. So, that's a little bit about the backstory. Tell us some of the pitfalls that you faced along the way too, because that'll translate into what you've learned to building a simpler portfolio and how to do this. And one of the ways you talk about is in an hour a year, right? Or a very short amount of time. So what were some of those pitfalls?
Yeah, overcomplicating things is one of them, definitely. And of course, I also did that mistake in the past. Let me give you one example. My wife she has a very simple portfolio. She is investing in two funds, in two ETFs, in two stock ETFs. One is a global ETF and one is technology ETF. If I take a look at her results, she's outperforming Warren Buffett easily in the last decade or so. Why? Because if you simply invest in the whole market, if you simply invest in diversified portfolio of stocks, of course, they need to be good stocks. But if you are investing in a global and technology fund, these are the biggest companies in the world. These are all the Googles and Amazons and Teslas and so on. You cannot go wrong. You cannot go wrong because in good times or in bad times, the stock market over a long period of time will very likely go up. Why? Because of the money printing. All the governments are printing money left and right. And this means that there is more and more and more money in circulation. And this money, in the end, ends up in the markets. It ends up in the real estate market. It ends up in the stock market. It ends up in all these markets. And this drives prices up. And if we take a look at history, if you simply regularly invested in the stock market, you did amazingly good. And if you are also exposed to new technologies a bit, like my wife, and I'm also exposed to new technologies quite a lot because I'm a bit more aggressive compared to my wife, you cannot go wrong, I think, because technology is eating the world and it will eat the world also in the future. So yeah, this is what I mean by trying not to overcomplicate things is one of the biggest things that you can do for yourself. Of course, you can add a bit of Bitcoin in your portfolio. You can add a bit of precious metals like gold, but that's basically it, you know. We don't go into some kind of exotic products or strange products that you don't even understand because this usually lowers your long-term returns.
Okay, so don't overcomplicate the portfolio. You're saying that an example of this was your wife's, for example, who I think you said was 2 ETFs. And, you know, ways to overcomplicate the portfolio would be, it sounds like what you were saying at the end there too, of, you know, you can add some crypto, some Bitcoin, you know, reliable types of crypto or some gold, some precious metals, but not things that you don't understand. So is it the too many things in the portfolio is what you're talking about is overcomplication is my first question. And then is there a second pitfall as well?
Yeah, definitely having too many different funds or too many different products in your portfolio, this usually is not good because when you have too many things in your portfolio, it becomes harder to manage. It's also a drag on your processing power in your brain because there are so many things there and you cannot get hold of them. So yeah, definitely trying not to overcomplicate things because last time I read about somebody who has like 150 stocks in his portfolio. How can you manage that? You know, you cannot. You know, and if you have 150 individual stocks, it's like having a ETF. So basically, his returns over time will be the same as ETF returns. But with ETF, you just have one product, and you don't need to worry about 150 stocks, you know, and manage them. So yeah, this is like one of the biggest mistakes that people make, and also people who are into crypto. They are trying to buy all sorts of small coins that will eventually go to zero because in the crypto space, only Bitcoin and maybe a few big projects will survive. Everything else will gravitate toward zero because there is no liquidity for millions of these small tokens and coins and so on, you know. So yeah, try to stick with what worked in the past with asset classes that are that are proven. And yeah, of course, if something new pops up, you can risk, but maybe just a couple of percent of your portfolio, and don't go into new stuff with 60% of your portfolio, because these things can also fail. Yeah.
Okay, got it. So it sounds like the biggest thing, the number one thing that you're really expanding on and emphasizing is don't overcomplicate. And I think for reasons just like you were talking about is, that individual who had like 150 stocks, that is not only a lot to manage, but it's a lot of headspace and takes up, mental real estate, so to speak. And so, the other part to that is stick with things that are reliable. And I think that's one of the reasons why we love real estate here, but we also love things like businesses and, of course, passive income in general. And one of the reasons why I wanted to have you on here too is to help round up some of that thinking for the total asset allocation, right? Of a portfolio, because it's not just real estate, it's not just businesses. There are public equities, there are bonds, and there are new things which you could take a much smaller slice of the portfolio, like you were talking about as well. And so let's talk about what people should be doing instead, right? So tell us what should people be doing instead? Obviously, looking for lower cost, indexes or ETFs. What else? How should they build this portfolio?
Yeah, one of the main concepts that I learned in life is that first you need to build your money-making skills when it comes to money. So first you need to be able to increase your income. First you need to be able to make more money, and you do that by learning new business skills, maybe taking a bit of a risk, going into some new projects, developing new products in your business, and so on. So the first part is, of course, increasing your income. And then the second part is how to invest that money. And when it comes to investing, I'm always a bit more conservative compared to what I do when making money. So one of the quotes from my book is, love risk when making money, hate risk when investing money. And there are a lot of examples when people, for example, let me give you a well-known example, Boris Becker. He was a very famous tennis player in 80s and 90s. He made like 50 million US dollars at that time playing tennis. Now it would be worth much more, this amount of money. But when he finished his career, so he was very good at making money. But when he finished his career, after like 10-year period, he went into a personal bankruptcy. Why? Because he started to invest in all sorts of exotic opportunities. For example, he bought a stake in a Nigerian oil company that later they found out that it is a fake company. It was a house of cards. And he was making all these investments, and he didn't even know what he's investing into. So he didn't do his research. He was very good at making money, but he was very bad investor. So he didn't do his homework. And this is one of the things that I warn people about. That when it comes to making money, yes, take a lot of risks. Be courageous, be bold. But when it comes to investing, it's much, much, much better to be on the conservative side. Because if you are a bit more conservative over a long period of time, you will outperform by far all these people who are too aggressive when it comes to investing.
Yeah, definitely. And I think, that speaks to one of the things that I have learned from many of my partners and just from investing education as well is, it's one thing, and maybe you can comment on this too, is it's one thing to hear about the stock market and the averages of 8 or 9%, right? But it's another to have something with low volatility, and so that compounds itself over time, right? And that's kind of what you're talking about, do things with less volatility so that money can actually compound. Because if you look at things over time, you're going to have smaller amounts compounded over time is way better than 20% this year and minus 15 the next year and stuff like that, right?
Yeah, when it comes to the stock market, if you are a long-term investor and you are not afraid of these big ups and downs, the stock market is great. And yeah, I'm investing in the stock market, but I don't care what will happen next year with my portfolio. If it goes down 30%, I don't care. I will just buy more. I will just regularly invest more because I know that there is a very, very high probability. It's never a certainty, but it's a very high probability that the stock market will be much higher in 10-year period or 20-year period. But in the next year, you never know. It can be plus 30% or it can be minus 30%. It can be plus 10%, it can be minus 10%. You never know. So you have all these ups and downs, and you need to understand that this can happen in the markets. And as a long-term investor, you shouldn't care about these things. So this is the key.
Okay, so we're looking at things that long-term investing as how we should build this, right? That's kind of a principle. And you talked about earning income is important. I would also probably add a 1.5 step in there. Maybe you would agree, of making sure that you're controlling your income and your costs. One, it's not great to earn a bunch, but if you're not able to save it, because then you have nothing to invest, right? And that's kind of a given, but kind of sliding that in there in the middle. And then you're talking about investing conservatively, so being more risky with your earning income. Taking bets on yourself is kind of how I'm listening to that, interpreting that, and then it's investing conservatively. So how does someone go about doing that then, going to do this investing part, like tactically? What are some things you can mention about that?
Yeah, the simplest thing or the most important thing is to start. Like I said, I am a business owner. When I started my career, I was an entrepreneur, and for years I didn't invest because I invested everything in my business, of course, in order for this business to grow. But after a while, when this business became profitable, then of course you need to diversify a bit, because if you have all the eggs in one basket, your business, I don't know, something can happen in the market. Even though you think, oh, my business is infallible and my business is the best in the world, but something can happen. There can be some kind of disruption. There can be some new competitor coming. There are thousands of ways how you can go out of business, or how your business can go down. So I realized that I need to invest in order to build my financial security. And this is the key lesson. You need to start as a business owner. You need to diversify into real estate. You need to diversify into the stock market, because this will give you more security and peace of mind. Because even if your business has problems, then okay, I still have my stock portfolio, I still have this real estate or whatever, and this is super, super important for your peace of mind. And you start by opening your stock brokerage account, for example, and you start to invest, and that's it. So you need to take the first step. Like Lao Tzu once said, the journey of 1,000 miles begins with first step. That's it.
Yeah, absolutely. So, I mean, for sure, right? Like, and the way I think about this too, for many of the people listening, they may not have their own business, but what they do have is themselves, and they have their own skill, and they solve a problem with their own skill. Just like a business in a much larger sense, an organization of people are out there to go solve a problem for maybe customers, whether that's business or other individuals. The point is the same, is that they have a skill, they're applying it, they're earning income, they invest. So they are, I'm Steven Incorporated, or Steven LLC, you are Robert LLC, right? And so from there, anything else, you're taking a percentage to go and invest. And the first thing is to take that first step, open that brokerage, a normal brokerage, or with a Roth account, something like that, to go find things with lower cost ETFs, index funds, like you're talking about, and just getting going. I wonder, there's something you talked about here too, which is the $1 million decision Does that have to do here with building out portfolio as well?
The $1 million decision is simply a decision to pay lower fees when it comes to long-term investing. Because like I said, small fees can mean big financial problems in the future. Mm-hmm. And this is the $1 million decision. If you just lower the fees that you are paying when investing for the long run, you can easily save over $1 million. This is the $1 million decision.
Awesome. Appreciate that. And so anytime you can lower expenses, that is going to help you to have your money compound more. So we've got to wrap up in just a few. I know you've got a busy day ahead of you, and I'd like for you, talk about how someone can actually, once they get things going, you're talking about, building a portfolio in an hour a year, or continue to, I'm not exactly sure what exactly strategy is, but can you tell us about what that looks like in, I think it's an hour a year, is that right?
Yeah, it's simple. For example, you just pick some ETFs. For example, like I said, my wife is investing in a global ETF and the technology ETF. I do things similarly, but I maybe have a couple of more ETFs. Mm-hmm. And then you just regularly invest, and that's it. No thinking, no overcomplicating, not thinking about when to invest. You just put in your calendar, 4 times per year, quarterly or monthly or weekly, you invest a certain amount of money in these ETFs, and that's it. That's in a couple of hours per year. That's it. You don't need more time. You just invest regularly. You put that into your calendar, and that's it.
Got it. So it may not be 1 hour on the first year, but certainly, there might be, especially for brand new investors or newer people to the stock market, many people may be listening and they'll have company stock, right? This is, many people are listening from tech, but it'll take some learning curve to learn about the ETFs indexes. You've talked about what they are already. And so it makes sense about being able to invest in multiple things, invest in one product that has a whole list of companies versus many, many individuals. But afterward, it is going to be significantly less, because then it's just about maintenance versus that energy output of getting it started then, right? What are your thoughts on, so it's really just kind of a, checking in and on it on something like a quarterly basis. Like that makes a lot of sense, investing it and not touching it so that the capital can go to work. How do you feel about automating?
Yeah, when you invest your money, after that, you should just leave it there. That's it. You don't need to check your portfolio every day. It makes no sense. It's much worse if you are checking your portfolio all the time, because this will lead you to some kind of rash decisions. You will panic when the market goes down 30% or something. So it's better to just invest and leave it there, and that's it. Don't even care what is happening with your portfolio in the short.
Awesome. I'm going to ask you one more question here, and then we've got to wrap up. But, looking back to Robert, when you were first starting, maybe a couple years after you were getting going with the business of web design, which I think is, cool to hear a part of your story. And you were getting started with your investing career here too. What is a piece of advice that you would tell him so that he would be successful a lot earlier on as well?
Yeah, I would just say, be extra conservative when it comes to investing, because when we are young, we tend to be very aggressive when it comes to investing. We try to find all sorts of opportunities to get rich quick, but they never work. They never work. So I would say to myself, Robert, be very conservative. Don't chase the hot investment opportunities. Don't go into crazy crypto coins or whatever. So just be very conservative.
Yeah. Build up the skill, make sure you have steady streams. And as you learn more, go from there. Robert, thanks so much for being on the show. Where can people find you? Where can they get their book? How would you like them to connect?
Yeah, you can go to my website, robertrolih.com, so my name and surname.com. Also, I have a 90-minute free online masterclass there where I share my free key things my free keys to investing in the age of money printing and AI, and also how to succeed when it comes to long-term investing. This is basically it, my website and my 90-minute free online masterclass.
Awesome, man. I'll make sure that it's in the show notes as well.
Perfect.
Thank you. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.